increased unit volume. Not only are we benefiting from ongoing AI investment trends, but we are also experiencing strength in industrial, aerospace and defense, and the reemergence of transportation. Third, growth is broad-based, and we are still in the early stages of a mass market upturn as backlog from our mass market customers continues to slowly ramp. Fourth, value-added services remained a differentiator, with supply chain services once again contributing significantly to overall profitability. Encouragingly, these favorable demand signals are interconnected, with each contributing to a broader opportunity set across our portfolio. As we have highlighted previously, Arrow remains well-positioned at the intersection of several attractive secular growth markets, allowing us to benefit from their continued expansion. Finally, the quality of our growth continues to improve, supported by a more favorable mix of customers and geographies, contribution from value-added services, and ongoing productivity gains across the business. Combined with the structural changes we have made to reset our business model and our disciplined expense management, these factors are enabling us to deliver meaningful operating leverage and generate strong incremental returns. Turning to slide 4, I would like to briefly revisit 4 pillars of our investment thesis and why we believe Arrow remains uniquely positioned for long-term growth and an attractive investment opportunity. I have discussed these pillars over the past several quarters, and you are starting to see the true strength of the business come through in our results. First, Arrow maintains a strong position in large and growing markets and plays a critical role in our 6 core markets of industrial, transportation, aerospace and defense, medical, consumer electronics, and data center. These end markets are supported by favorable secular trends that continue to create growth opportunities. Second, Arrow has differentiated capabilities driving profitable growth. We are benefiting from a richer mix of higher value service offerings, including supply chain services, engineering and design services, and integration services. Notably, these offerings build upon our long-standing strengths in our core distribution franchise and represent a natural extension of the capabilities that have long differentiated Arrow in the marketplace. We continue to expand our suite of differentiated capabilities that deepen customer engagement and further differentiate Arrow. We recently introduced Digital Test Drive, a new remote AI-driven engineering platform that allows customers to evaluate hardware, benchmark performance, and accelerate product development without the logistics and delays associated with physical evaluation of equipment. This expands our ability to support customers globally while increasing the efficiency and scalability of our engineering services. Additionally, our eInfochips business continues to strengthen its position as a leader in engineering services. Its differentiated silicon-to-cloud capabilities help customers navigate increasingly complex product life cycles. During the quarter, eInfochips was recognized in Gartner's Emerging Market Quadrant for Physical AI Services, reinforcing the strength of our technical capabilities in this rapidly evolving market. We also recently expanded our ECS Experience Centers, providing partners access to more than 100 pre-built hybrid infrastructure, cybersecurity, and AI solutions alongside our engineering expertise to accelerate solution development and deployment. Historically, these engagements have resulted in a proposal close rates of approximately 90%. I'm proud to share that Arrow recently earned 3 key Microsoft distinctions for our ECS business: Frontier Distributor Status, Specializations in Copilot, and Azure Virtual Desktop. Together, they validate our scale and expertise across AI, cloud, and the modern workplace, strengthening our ability to help channel partners deploy scalable solutions through ArrowSphere and supporting continued growth in recurring cloud consumption. Third, Arrow has a diversified business model that provides financial flexibility, supported by strong balance sheet and consistent free cash flow generation. The combination of our global components and ECS businesses is a strategic advantage, allowing us to participate across the full technology lifecycle. And fourth, our focused capital allocation strategy is designed to maximize shareholder value by deploying capital where we expect the highest long-term risk-adjusted returns. We will continue to reinvest in the business to drive organic growth, evaluate disciplined M&A opportunities, and return excess capital to shareholders while maintaining an investment-grade credit rating. Turning to slide 5, we are very pleased with the strong results we delivered during the second quarter, which reflect our team's disciplined execution and the progress we have made over the past several years. We continue to build on our traditional distribution DNA, all while expanding our higher margin value-added services across both Global Components and ECS, creating a broader portfolio of solutions that strengthen customer relationships and improve the quality of our earnings. We believe Arrow is uniquely positioned across both the hardware and software technology ecosystems, giving us the opportunity to participate broadly as our customers continue investing across the full technology lifecycle. As we enter the second half of the year, our focus remains on improving the quality of our growth through strong execution and disciplined financial management. We continue to make targeted investments in opportunities supported by customer demand and attractive long-term returns while maintaining a highly efficient business model, which we expect will drive additional positive operating leverage. We are confident in the direction of the business, encouraged by the opportunities ahead, and remain focused on creating sustainable long-term shareholder value. With that, I'll turn it over to Raj to discuss our financial performance in more detail.
Thanks, Bill. On slide 6, sales for the second quarter increased $2.4 billion year-over-year to $10 billion, exceeding our guidance range and up 32% versus the prior year, or up 30% versus the prior year on a constant currency basis. Second quarter consolidated non-GAAP gross margin as a percent of sales of 11.2% was flat versus the prior year. Our second quarter non-GAAP operating expenses increased $88 million year-over-year to $719 million, primarily driven by variable costs and FX. Importantly, non-GAAP OpEx as a percent of gross profit declined 10.5 percentage points year-over-year to 64.1%. We continue to focus on disciplined, profitable growth, and our efforts around operational efficiency are driving substantial operating leverage in the business model. In the second quarter, non-GAAP operating income increased $188 million year-over-year to $403 million. Non-GAAP operating margin rate expanded 120 basis points year-over-year to 4% of sales. Interest and other expenses was $37 million in the second quarter as we benefited from lower average debt levels throughout the quarter, and our non-GAAP effective tax rate was 23%. Finally, non-GAAP diluted EPS for the second quarter increased 124% year-over-year to $5.45, which was above our guidance range, driven by a number of factors including favorable sales volume, continued strength of our value-added services, operational leverage from productivity initiatives, and lower interest expense. Turning to slide 7, let's take a closer look at our Global Components business. Global Components sales increased $726 million sequentially to $7.4 billion in the second quarter, above our guidance range and up 11% versus prior quarter. Global Components non-GAAP operating income increased $32 million sequentially to $397 million, up 9% from the prior quarter. Non-GAAP operating margins modestly declined 10 basis points sequentially to 5.4% and were up 180 basis points versus the prior year and well ahead of expectations. The growth that we experienced in the second quarter was once again broad-based across geographies, industry verticals, and customer segments, underpinned by healthy trends in our leading indicators. Book-to-bill ratios continue to increase and remain well above 1 in all 3 regions. Overall, lead times continue to extend for certain technologies, but they remain lower than a pervasive shortage environment. Customer order patterns broadly are normal in size and pace, reflecting a rational market environment. Our backlog construct continues to grow and is building out into the first half of 2027, giving us visibility and confidence in the sustainability of the business's momentum. Encouragingly, the growth that we are seeing continues to be led by customer unit demand with some incremental lift from price inflation. Price inflation contributed roughly one-third of the sequential revenue growth in our global components business. Memory now represents a low double-digit percentage of total segment revenue. Our strategy remains focused on profitable growth, and our execution is driving a healthier business mix. First, while we continue to benefit from secular growth trends related to AI and data center, we are experiencing broad-based demand across our portfolio rather than concentrated in a single market. Strength in aerospace and defense, industrial, and the reemergence of transportation, particularly in the West, are presenting tailwinds to our global components business. These are our three largest verticals globally. Second, book-to-bill ratios and backlog across our mass market segment continues to improve, and we believe there is still healthy runway. Third, interconnect passive and electromechanical components, or IP&E, continue to grow, surpassing $1 billion in sales for the second consecutive quarter. Fourth, our value-added services, primarily supply chain services, made another meaningful contribution to our overall second quarter operating income. These capabilities expand our addressable market, deepen customer engagement, and increase the durability of our earnings. Lastly, we have remained disciplined with our cost structure and have added positive operating leverage to our model. This discipline is expected to drive continued flow-through as the broader market grows and expands. Taking a closer look at each of the regions. In the Americas, sales growth was broad-based, highlighted by strength in aerospace and defense, industrial, and transportation. In EMEA, the market was underpinned by strength in transportation and aerospace and defense. And finally, in Asia, sequential growth was driven by industrial, transportation, and demand for data center computing power. Turning to slide 8 and our global ECS business. In the second quarter, global ECS sales increased $332 million year over year to $2.6 billion, above our guidance range and up 14% versus the prior year, or up 13% year over year on a constant currency basis. Total ECS billings were $5.9 billion, up 14% year over year. Our global ECS business is strategically positioned at the complex end of the IT stack, where hybrid cloud and AI demand is driving healthy backlog growth of over 75% year over year, finishing the second quarter at another all-time high. We are experiencing strength across our portfolio of cloud, cybersecurity, data protection, data intelligence, and infrastructure software. Today, hardware solutions for on-premise storage and compute remain constrained by thin supply, mostly due to memory and SSD shortages. However, our role in the middle of technology makers and channel partners allows us to source, provision, manage, and scale alternatives that lean more on the software and public cloud solutions that we offer. And our single integrated ArrowSphere platform continues to help drive these efforts, unlocking deeper engagement and recurring revenue volumes. In the second quarter, we took a charge on certain underperforming multi-year contracts with one of our partners. As a result, second quarter ECS non-GAAP operating margins declined 100 basis points year over year due to the charge. As we have noted in prior quarters, we have been working through discussions with one of our strategic partners, with whom we also have these beyond distribution relationships. This is a highly valued relationship, and we wanted to ensure we reached the right outcome. We have now terminated one key element of our beyond distribution agreement with this partner and continue to work towards restructuring another. We believe these actions will help to get this part of the business on the right track. Both of us remain committed to achieving success going forward. Turning to the balance sheet on slide 9. Net working capital declined sequentially in the second quarter by approximately $100 million, ending the quarter at $6.8 billion. Inventory grew sequentially by $217 million, ending the second quarter at $5.9 billion. Importantly, the financial metrics that we monitor continue to significantly improve. Return on working capital increased 10.9 percentage points year over year, finishing the second quarter at 23.6%. Likewise, return on invested capital increased 5.8 percentage points year over year, finishing at 13.9%. Working capital as a percent of sales declined in the second quarter to approximately 17%, and our cash conversion decreased year over year by 23 days. Cash flow from operating activities in the second quarter was $318 million, taking us to over $1 billion of operating cash flow year to date. The strong cash generation is driven in part by timing effects from our supply chain services offering, which may partially unwind as the year progresses. This offering is largely working capital light because the inventory is typically consigned, but AR and AP cash flows within existing customer-supplier relationships can create quarter-end swings. In general, the countercyclical cash flow dynamics of our business model have not changed. Gross balance sheet debt at the end of the second quarter declined sequentially by approximately $300 million and declined year over year by approximately $650 million, finishing at $2.2 billion. Our lower debt levels, along with increased profitability, has improved our adjusted leverage ratio by over a turn the past 12 months to 1.75 times, which provides us with increased financial flexibility. Finally, we repurchased $43 million in shares in the second quarter. Now, turning to Q3 guidance on slide 10. We expect sales for the third quarter to be between $9.6 and $10.2 billion, representing an increase of 28% year over year at the midpoint of the range. We expect global component sales to be between $7.5 and $7.9 billion, representing sequential growth of 5% at the midpoint. In Enterprise Computing Solutions, we expect sales to be between $2.1 and $2.3 billion, which is up 2% year over year at the midpoint and reflects growing over a large partner addition last year. We're estimating a tax rate in the range of 23 to 25% and interest expense of approximately $50 million. Our non-GAAP diluted earnings per share is expected to be between $4.83 and $5.03. Details about the impacts of changes in foreign currencies can be found in our earnings release. As we look to the balance of the year, we remain confident in the momentum we are seeing across the business and our ability to execute our strategy. At the same time, we recognize that a number of factors can influence the timing and linearity of results from quarter to quarter. We expect Global Components to perform at or above seasonal trends in all of our regions for the remainder of the year. However, consistent with historical patterns in Q3, Asia is expected to be seasonally strong, while EMEA is typically seasonally weaker. Additionally, our supply chain services is expected to return to more normal profit levels in the third quarter. Overall, we are confident that our healthier business mix, diversified business model, and financial discipline will enable Arrow to deliver additional operating leverage and drive significant earnings power. With that, I'll now turn the call back over to Bill for some closing thoughts.
Turning to slide 11. As we look ahead, we remain focused on disciplined execution, building on the operational momentum we have established, and further improving the quality of our growth. Leading indicators continue to reinforce our conviction that underlying demand is strong. Combined with the actions we have taken to enhance efficiency and optimize our operating model, we believe we are well positioned to realize increasing levels of operating leverage. Our strategy is producing tangible results and strengthening our competitive position across our markets. As a result, we believe we are well positioned to capitalize on emerging opportunities and convert them into sustainable, profitable growth. We will continue investing in innovation and customer enablement to deepen relationships and expand our value proposition with the disciplined focus on allocating capital to the highest return on investment opportunities. In parallel, we will strive to continue growing our portfolio of higher margin value-added services across both Global Components and ECS, deepening customer engagement and supporting more durable, higher quality earnings over time. Everyone at Arrow is proud of the progress we have made, confident in the direction of the business, and remains committed to creating long-term value for all of our stakeholders. Finally, I'm excited to welcome Dee Merriweather as Arrow's new President and Chief Operating Officer. Dee's extensive distribution experience and successful leadership of commercial, operational, and financial teams will further strengthen our organization. Just as importantly, she brings the humility, transparency, and purpose-driven leadership that aligns with our culture and commitment to delivering value for all of our stakeholders. These additions strengthens our succession planning, and I will continue to serve as Arrow's interim CEO until a permanent CEO is named. With that, Raj, Rick, Eric, and I would be happy to take your questions. Operator, please open the call for questions.
We will now begin the question and answer session. If you would like to ask a question, please press star 1 to raise your hand. To withdraw your question, press star 1 again. We ask that you pick up your handset when asking a question to allow for optimum sound quality, and if you are muted locally, please remember to unmute your device. Please stand by while we compile the Q&A roster. Your first question comes from the line of Will Stein with Truist Securities. Will, please go ahead.
Hey, thank you for taking my question. Congrats on the good overall results and outlook. I have a couple just a couple quick questions. First, I think we're about 5 quarters into the component cycle in terms of expressing year-over-year growth. It's a very robust growth level now. I think it's 2 quarters of 39, pushing 40% year-over-year growth. What inning would you say we're in terms of that dynamic? Are you seeing things that make you concerned that we're in the sort of the last couple innings of that cycle? You think we're at the beginning still, or perhaps somewhere in the middle?
Hey, Will, thanks for the question. It's Bill. The starting pitcher is still in the game. All right. We haven't gone to the relief pitcher yet, so it's the early innings of the game. I would say, we're in the second inning, somewhere in that range. But Rick is sitting here, and he's living it every day. So I'm going to turn it over to Rick.
Yeah. Thanks, Will, and thanks for the question. And I'll build on, Bill's response. When we look at this recovery, it's really 3 different, positions in the recovery cycle, if you want to call it that. You have AI, which is not a recovery. AI is a market that's evolving and will continue to evolve. You have what's happening in Mil-Aero, and then you have what's happening in the core business, which is fundamentally the growth drivers to which we've always seen recoveries happen in the business. And as we said before, I kind of look at it and say it from this perspective. The growth in the core business is steady. All the indicators are strong. Backlog continues to build, and there's plenty of time left in the game from my perspective as it builds.
Yeah, that's really helpful. Next, I want to highlight sort of a question mark in the guidance. Your ECS guidance is below typical seasonality. I was a bit surprised by that. And perhaps related to this, there was a report mid-quarter noting that there was a departure of a supplier relationship. I think this called out a $1.4 billion revenue level of business, but I think that might not have been perfectly accurate. And so I'd like you to maybe set the record straight in terms of whether there was a loss, the timing of it, the sizing of it, and whether that's perhaps what we're seeing in the Q3 guide. If it wasn't that, maybe elaborate on that. Thank you.
Yeah, Will, great question, and thanks for bringing that up. It was a misreport on the $1.4 billion. It's roughly half that at $700 million on the revenue line to us. But Eric is here, and I'll let Eric dive into that deeper if you'd like.
Yes, there will be no impact in terms of revenue and margin and profits for ECS with this loss of a contract. It's in fact, it's a mutual agreement. Sometimes the strategy between the vendors and the distributors are diverging, and this was the case here. And basically, we are not a volume distributor, a laptop or PC distributor. We are an infrastructure, software, hardware distributor, and cloud, and we are focusing on this. And so basically, this particular vendor wanted to have distributors that can do both, and this is not our case. So we will focus on alternative solutions, and our partners will buy from us alternative solutions, and we do not expect any change at all in terms of the growth or whatsoever.
And then, Will, just the other part of your question was the below seasonal guide that you referred to. The growth rate in the quarter on a year-over-year basis is primarily the result of growing over a large partner addition last year. There's no change in trajectory of the overall business. We still expect to get to low double-digit billings growth during the course of this full year. So it's really a grow-over issue for this particular time frame.
Yeah, I'll just add to that, Raj, for a moment. The ECS business, the base business, the core business is quite strong. Our backlog is up 75%, as Raj noted in his script. And if you look at the product segment, the performance within the product segments on a year-over-year basis, security is up 21%, compute's up 51%, business application is up 26%. So there's a really strong, healthy demand out there, and we're parked, as we've always said, kind of right in the center of that ecosystem. So the business is doing very well.
Thank you.
Thanks, Will.
Your next question comes from the line of Melissa Fairbanks with Raymond James.
Hey, guys.
Hey, Melissa.
Thanks for taking my
Hey.
question. Hello. Good to talk to you again. Congrats on a great quarter. Dee, welcome to Arrow. You're joining a great team, so I look forward to meeting you. I wanted to see if you might be able to comment on some of the things that we've heard from some of your suppliers during this earnings season about how automotive OEMs are now beginning to pressure some of their tier ones to maybe carry more inventory because we went way too far into the correction territory and things are too lean, and now we're seeing lead times extend. I'm wondering if you're seeing any of those types of dynamics where this is going to be now we're back to normal, kind of not just in case, but also not as lean as the just-in-time times were.
Yeah, Melissa, it's Rick. Thanks for the question. I'll answer the question this way. I think if you kind of put the cycle into play, we went from a cycle where obviously we went through the pandemic, inventories got elevated. The cycle we went through, everyone bled off a lot of inventory or held a lot of inventory and had to bleed it off. And then we've seen this, progression of a really nice, slow recovery. And in that recovery, discipline has come back into the supply chain overall. Customers are now adding buffer inventory back into their supply chains, as well as giving us more visibility and extended visibility to what their MRPs are showing from a longer period of time. I don't think any one particular segment is reacting or acting much differently from an overall perspective. But I do think is happening is some of the traditional vertical markets to which carried more inventory per se than others are building buffer inventory back into their mix as it relates to what they're seeing from a demand perspective. But I don't consider it irrational in any way at this point in time. I don't.
Okay, great. Thanks, Rick. I appreciate that color. So just kind of building upon that, you are getting better visibility. Raj, I think you commented that you're now, you have some visibility extending into 27. As lead times are extending, especially for some of the higher value products that are going into the data center or the IP&E stuff, are any of your customers looking to pre-position inventory and maybe having you manage that supply chain for them and then just put that inventory on consignment in place? I'm wondering if that's a dynamic that's been happening.
No, it's Rick again, Melissa.
Okay, Rick.
As I said earlier, I don't see anything irrational from that perspective. I don't see, we don't see a lot of panic out there. Lead times, when you think about them overall, there are some lead times that are extending based off technology. Other lead times are extending based off of demand that's basically putting on them, but nothing irrational from my perspective overall. Pre-positioning of inventory or buffers or bonds, established by customers are relatively normal from what we would see in a normal cycle. So I don't see that necessarily panic out there in any way, shape, or form, driven either by price or by end market demand at this point.
Perfect. Thanks very much, guys. I appreciate it.
Thanks, Melissa.
Thank you.
Your next question comes from the line of Ruplu Bhattacharya from Bank of America.
Hey, Ruplu.
Hi, thanks for taking my questions. Hi, Raj. I want to start with the ECS billings. It looks like in the second quarter, EMEA had very strong billings, 22% year-on-year change. Americas was more in the mid-single digit range. Can you talk about what drove the difference in performance between the two regions?
I'm going to hand it over to our expert here, Eric Nowak.
Yes, as we already explained, we aligned the strategies of America to Europe some, let's say, quarters ago now. And so basically, this strategy around hybrid cloud and AI in the mid-market and much more software and much more mid-market, that's also now it's completely global. We are deploying our Sphere platform now also in the US. And so basically, we are up and running and for years and years in Europe. And so we are taking profit of this. In the US, it's now it's ramping up. But of course, we still need a couple of quarters to be at the same level.
Okay, thanks for the details there. Raj, can I ask a follow-up on margins? So on ECS, there was 100 basis points year-on-year decline. You said there was a charge. Can you quantify how much was the year-on-year impact from the charge? And then how should we think about ECS segment margins as we go through the rest of the year? Typically, the fourth quarter sees a big jump. Are you still expecting that? And then on the similar question on the core business in components, should we expect that you can maintain healthy 5% plus margins? What are the puts and takes? If you can give us any details you can.
Yeah, absolutely. We did take a charge within the ECS business that impacted the margins within ECS by 100 basis points. That equates to $27 million. Had it not been for the charges, the margins would have been at well over 4%. The charge relates to something we've been working on with one of our key partners to restructure and change the economics around some of the beyond distribution contracts. And one key point of progress we made was we terminated one key aspect of the beyond distribution relationship with this partner. And we are working to restructure the other one that has been causing us some issues. We still have a great relationship with this partner, so we want to make sure that we work it out in the right way. But I think we're on the right path there. I do expect some more charges in the second half of the year, probably at a lesser pace than what we saw in the second quarter. But once we get behind the restructure, I think we'll be on a good path there. And as Bill had mentioned earlier, the core business continues to perform really well. So no concerns at all there. And Ruplu, on your point around the fourth quarter seasonality, we'll expect to see very high margins again in the ECS business in the fourth quarter, as we always do. We get double the volume. We get margin expansion because we're leveraging the OpEx. And so I would not expect to see anything different there. Remember, though, that we had 4 extra ship days in the first quarter of this year, which will be 4 less in the fourth quarter of this year. But other than that, the dynamics should be exactly the same. With respect to components, we've been operating at around 5.5% margins in the first half of the year. So we're really pleased with the margin expansion. And in our guide for the third quarter, we do believe that Asia will continue to have strong growth. And our supply chain services offering will step down a little bit to a more normalized level of profit. But I would be surprised if we didn't get to 5% margins again in the third quarter. And so we're on a different path now. The margin will ebb and flow for components, but we're in a great place. All the conditions that have gotten us here thus far, like the right kind of geographic mix, the mass market customer coming back, value-added services, and the leverage we're getting on the cost structure, all those conditions will continue to be in place, and they're not changing anytime soon. So we feel pretty good about the margin profile in components.
Okay. Raj, thanks for all the details there. I'm going to try and sneak one more higher level question, and this is for Bill or Raj or anybody who wants to chime in. Right now, it seems like everything is going really well. I mean, you have good backlog, you have increasing visibility, and markets are strong. Can you just talk about, like, as component costs are increasing, I mean, are you concerned at all, whether it's in the ECS segment or in the component segment, that end market demand can decline or there could be some destruction of demand? And what risk mitigation are you taking so that if that happens, how would you react to that? Thanks for taking my questions. Really appreciate it.
Yeah, it's a good question, Ruplu. It's Bill. Good to talk to you. No, we don't see demand destruction in either the global components business or the ECS business. We see that the fundamentals in the market are quite strong, whether it's on the component side or the software side, ECS. And if you think through what Rick had said in his comment, there's three upward graphs that are taking place. One is AI, one is aerospace and defense, and the other is the mass market, and they're all trending up and to the right. And if you build those three graphs on top of each other, the market has expanded, and that's what we're benefiting from. And we see the continued expansion of that market. So when you look inside that market and you say, oh, these companies now don't have the ability to get storage. They don't have the ability to get compute on-prem. It has to go to the cloud. That perfectly fits in with what Eric's business does in supporting those businesses with enterprise-wide software. So we're really sitting at, we've always called it the crossroads of, the intersection of all of these secular demands that are going up and to the right. So we really feel good, and we don't see that demand is going to be destroyed.
Okay, thanks for all the details. Appreciate it.
Thanks, Ruplu.
There are no further questions at this time. I will now turn the call back to Bill Austin for closing remarks.
Thank you, operator, and thanks everybody for joining in today. And everybody here is excited that Dee is going to be joining us sometime in early September. I think it's September 8th. She'll be here. We're excited to have her joining us. She has great background. She's got great qualifications to come and join us in